Ameto. So I would now request our next speaker, Ms. Neha Agarwal, to basically give the insights about what is Angels and VCs all about.
Thank you. Hi everyone. Let's have a huge round of applause for Dr. Adesh first. I hope that woke up some of us after the lunch. Great. So I'm here to give a quick insight on the step after what Dr. Adesh had highlighted. So he rightly said that incubated startup is a good validation for any angel investors to bet on that opportunity. So I'll start with a quick introduction of us. So, sir. So we are Mumbai Angels. We are the premier angel investing platform, started back in 2006. We actually evaluate around 500 startups every month. So we have a portfolio base of over 200 startups with a next round and exit from at least 100 of them. Alright, so before we actually come to the investment in your startup, I think this is one question which all the entrepreneurs need to answer. Do we need funding? What is the requirement? Why do I need funding and how much do I need fund for? That incubator can help you obviously with, but investor won't answer that for you. That you have to come prepared before you approach any investor. Now what does the investor do? So it brings 3 C's to your table. One is the capital, connect, and counsel. Just to wake up some of them, can I just throw a question that why do you need connection from investor? What kind of connection can an investor bring?
One, we need connection among individuals. We are restricted to an industry, but the investor might be knowing multiple people, and by this we can chain our network.
Rightly said. So investors are connected to other startups. They would have maybe invested in a startup complementing what you are building, and could help you scale in a quicker way than you would probably do. We move to the next one then. So this is just a definition what Mr. Fred Wilson had highlighted, that venture capital, the value remains between the startup phase and the public, the IPO phase. So a quick overview of a fundraising process that we follow and that even the other platform follows. The first is your pitch deck, evaluation. Then comes the negotiation on term sheet, which then results to the definitive document called shareholders agreement. Investor due diligence, and as I said, negotiation and closure. We'll move to the pitch deck first of all. So what are the key elements of the pitch deck? So again, incubator are the first place you should always get help from when you're preparing. But as an investor, what we are looking at when we are looking at any pitch deck, it needs to So it needs to clearly convey what is the problem you are solving, what is the solution you are providing, for whom. It cannot be like I'm building an AI analytic tool, but I mean then what? Like I am helping the distributor reduce the load, the supply chain load, or inventory management for this and that. The market size, you need to know your market, you need to know your target audience, addressable, serviceable market. This clarity in the entrepreneur and who, what are the substitutes, what are the competition, and what differentiates you, why you are different or why you are better. I mean, it can be just different. It doesn't have to be better, just different but in a good way. The last, before the requirements and all, is the revenue model. How you are monetizing. If you have to clearly convey whom you are taking money from and how the money flows to the company, whom you are giving in between, or what is the monetization model, what is the business model of your startup. And again, as I think highlighted before also, traction is a key validation of what you have built has already been adopted. That is the key validation. So having said that, we've always invested in some of the pre-revenue companies also. In that case, we look at IP as a pre-validation and defensibility. Yeah, requirements of fund and financial projections as. Now, couple of mistakes we should be avoiding in the pitch deck. Don't make it too long, don't make it too boring, don't have a flow, have a storyline, personalize it with your story, personalize it with your reason to build this. Vagueness and ask is another thing, another one I'll highlight from here. Like, generally we get these startups asking like, okay, I want to raise like 1 to 3 million or 1 crore to 3 million. You can there cannot be a huge difference. You probably 10% fine, but you have to be clear how much you are raising, why you're raising. That vagueness is not good to be, when you're approaching to any investor. Alright, not sure if others can read it, so I'll try and highlight it. Okay, so now when we are looking at evaluation parameters, what you are building, your startup is a function of differentiator or a disruption. As I said, innovation is good, but it is not like a theory, like, you say innovation and it's there. So differentiator is also one of the things which you can build on, how you're adding to the convenience of whatever the existing model is. Customer attraction, as we've already discussed. Now, who the supply chain, from the supply chain we want to know how you're building it, either its own or you're taking it apart from the other suppliers, and who are your customers. So who are your suppliers and customers, that understanding, that evaluation, what kind of suppliers, what is the dependence on them, that is also key when we are evaluating. But very, very important is the profitability. We all understand, I think Byju's is still not profitable, but there needs to be that path to profitability. That focus on profitability can come from your unit economics, your marketing strategy. So that clarity, okay, you as a startup, as an entrepreneur, you foresee yourself breaking even in 3 years, in 2 years. That clarity, that needs to be there. You can't just build a startup to take money and burn. That focus on being self-sustainable at some point needs to be there. After that, yeah, of course, teams, competition, the potential to scale, these are the key parameters we evaluate. Next, sir. So, quickly on valuation, I think this is also one of the very challenging topic we keep getting. So there are a lot of methodologies for valuation. There's DCF, there's there are more, but all of those don't work for an early stage startup. We have to understand that their projections are, they're just building up. So what do we use? What do we do in that scenario? We look at the similar, not same, but similar startup in the same sector, that how, what is, how much they raise, what are the multiples to their revenue they raise at. Also, it is back calculated at what this company could ever value. I want to make 10x on that company, so what should I invest at? A little clear or confused?
Not clear.
Okay. So there are two ways. There's a monthly revenue. You build an annualized run rate through that, and you put a multiple. That multiple comes from what is the current funding scenario, what are the similar companies raising funds raised at a multiple of. Having said that, this is just one metric. There are obviously, founder prodigy, how he has executed so far. Execution matters a lot. Than the idea, execution matters more. So all that also adds to the factor, to that multiple which we add to the. Anyways, I'll just quote Mr. Dr. Ashwath Damodaran. He's mentioned that valuation is what? It's a function of 3 variables. Capability to generate cash flows, growth on it, and the uncertainty around it. Now, we've done pitch deck, we've done what are the key evaluation criteria an investor look at. Can I take questions in between?
Yes, ma'am.
Anything till here? Anything on the evaluation criteria that what we particularly look at? Okay. Alright, so once we've evaluated, sure, go ahead.
There are few companies like Cred or Byju's who are not in profit sector, but then they get funding easily. So how is it possible? Because first thing is we should sell something.
So yeah, I understand. So his question has been around that how come the companies like Byju's and Cred been in the ecosystem for quite some time and are not really profitable but continue to raise money. Their unit economics, the gross margin, even the there are other ways. The gross margin ke baad there is contribution margins 1 and 2, which also involve your marketing spend, your logistics spends. So that number is what the VCs look at than the EBITDA. So that says that company has the ability to be self-sustainable. It can actually, without taking fund, it can sustain, it can actually grow money. But if I put money, it will accelerate that. And if I put money, that will be spent to accelerate it, which will continue the company to be a bit negative for a few more years. Then again this cycle comes. Did I answer? Alright. Okay, so after the evaluation of the company starts the negotiation on the terms. Basically this is a term sheet. Heard of term sheet? What is a term sheet? Is it binding, non-binding? Okay. So term sheet is it's kind of a legal document, but it is non-binding in nature. It is the first step in a transaction which clearly highlights the role of two parties entering in this transaction of investment. Like if I am investing X amount, what would be the valuation, what would be the number of shares I will get, and what do I have say in, and what would I not be bothered about. Clear? Very layman term I could explain it with. Alright, so yeah, so again, this is non-binding as I mentioned, it's a broad deal agreement. So when I say term sheet is non-binding, it helps reach to the binding agreement later after the due diligence. So this is a very important step when we are doing, whenever you are closing a term sheet, don't take it lightly. Make it as detailed as possible to be clear whenever you are closing it. It's a quicker closure than if you could close the term sheet properly. Then comes the due diligence. So once the term sheet is signed by any investor with the entrepreneur, that is when we start the due diligence of their business. Is it scalable? What are they saying? If they've, that they've partnered with so and so, we'll validate that okay, if somebody said that I have partnered with Netflix for one of their services, we'll validate that through an agreement. We'll speak with Netflix also. Then there is a regular financial, your balance sheet, your invoices, your compliance, the regular due diligence happens. Once that is cleared, that is when an investor invests in the company. In the due diligence, there are certain incidents that's not really high risk, but it is still something which was left by the company, but they are all corrigible, they are all correctable, right? So we can look at it like how we can, going forward, resolve this issue and still invest. I think this also with SHA, which is a shareholders agreement. It is a definitive agreement. Whatever is written and signed on this agreement is binding by law. But it's the same, like whatever you agreed with in the term sheet, that plus whatever the observation in the due diligence brings to the shareholders agreement. Alright, so negotiation on ask, on valuation, on what as an investor or as a founder you want your role to be. So So you just have to understand what an investor is bringing on the table, how. Sometimes negotiation is also, how what is the supply and demand of the funds you want. So you have to understand both the position you are in, that you have couple of term sheets or you don't. That gives the power of negotiation to either party. But just set the expectations clearly, what is the motivation of the company, whether to, add value, scale this investment. You have to convey this to the investor as well, like, the passion to create that startup, to add value to the startup, and possible very good returns to that investor. Okay, so now in the journey of the relationship between the investor and the entrepreneur, it needs to end at some point. So these are some of the ways you can give an exit to the investor. So whenever the startup is raising, I'll quickly touch these. So venture capital, whenever the startup is raising next round, the next investors who's investing may have an option to invest, one, a direct proportion in the company, second, buy out the existing investors from the company to increase my stake. So me as a next investor, I put a part money in the company and I get certain shares, and I also buy existing shareholders shares and I get more shareholding in the company. So this gives the early investor, the angel investor, an exit opportunity. Whenever, if there is a, it's a cash rich company, they've built in this capital in the company, and they can actually offer a company or a founder's buyback to the investors at a certain IR, which is defined in the SHA generally. That is another way to give an exit to the investor. Whenever there is a strategic investor, infusing money, buying the investors, just that it should be only just me and the founder. It could be strategic trade sale, it could be acqui-hire, that they also acquire the full company and hire the founders as their employees. But these are the ways to give exit to the investors. Secondary is like, if I am an angel investor, I find another buyer for my shares. This is not a public market, you don't have a price set here, it's all negotiation based. Obviously you have certain assistance, like what was the last round, what it should be. But so secondary sale is when you are selling your shares to anybody in the secondary market. IPO and winding up, I think it's very clear. Any question on the exits? What do you think is the most likely, how the investors mostly get the exits from early stage company? Yes, venture capital round. I'm glad nobody said winding down. Yes, it's VC. Generally, every time. I think when you ask an age of an investment, you get the first exit opportunity in 2.5 years. You may choose not to exit at that time because you believe that you can stay longer and make more return on that.
What's the difference between bank investment and investor?
Bank investment and
Investor.
Angel investment.
Okay. So in the bank investment, there is a set interest. It cannot go below, it cannot go above. Correct? Here, I have a couple of case studies I can discuss about. So there is, you can get the return as varied as 105% to 450%. But it can go down also. Bank investment, that is that safety net, right?
Bank will charge you only interest. Like that, angels will charge an interest on
No.
the share.
It's just the shares. There is no interest you get. There is an option of dividend, but none of the, very rare, very few startup would have provided dividend to their investors. But there is no interest part.
So what was the average share of the investor in your past experiences?
So we've done this.
Minimum and maximum.
I mean, maximum has been in 3 digits.
Oh.
Okay, but minimum obviously has been 0. There have been, I think, out of 200, around 30 companies would have been shut down. 220 is the actual number, and 30 shut down. But there are companies who have given us 14x within 1 year. So if you convert that in the IRR, in the percentage return, it is a 3-digit number.
0? Do you mean they didn't get any share?
No, they didn't get any capital grant. Alright. Okay, so this was primarily the journey. Yeah, I think I see some.
Good afternoon.
I can't hear you.
Please stand and ask questions so that you are seen. You can ask loudly. Please ask.
Ma'am, I have a doubt that if you are a owner of a company and I buy all the shares of the company, so who will be the main owner of the company, you or me? Because you have done the startup of the company and I have bought all the shares, but you are still having a 5% or 6% share in that company. Then who will be the owner, you or me?
The one who let me repeat your question for everybody's ease. So you are asking that you started a company, but then there is someone came who bought 95% of the company and left 5% with you, right? You remain to be co-founder because you started that idea, you founded that idea, but the ownership changes to the one who has more than 50%. The operational call, the operational decision will be taken by that person. Who's taken more than 50% of the company. So just to understand the journey of investment, I've just prepared 2 case studies. We'll go to the first one. So there's a company called Purple. Who all have heard of Purple? That's it, just like a few. Who all have heard of Nykaa? Okay, so this is a direct competitor to Nykaa. So we invested in Purple back in 2013 when the company valuation was, it's not written, but it was around $5 million. Yeah, so we invested back in 2013. Just after our investment, there were a couple of more investment which validated our idea. There were, I think, Artha came after us, then Ivy Cap. 2016 is the one where they actually raised from a bigger, a tier 1 VC. Bloom Venture entered in 2016 with 6 million plus check size. They raised after that, from JSW. The last was Goldman Sachs, World Invest. Our investor kept getting the exit opportunity in all these rounds after 2019. So 2019 is when some of the investors exited at 20x. In what, 6 years? 6 years, 20x. The multiple kept increasing. The last exit opportunity was at 70x. In less than 10 years. So did I answer your range? Alright, so the next one again, I think Mr. Endo sir is also invested in. So Add-on Mo, which does an OTT advertisement. So you remember those taxi tops? There were screens on the taxis in Bombay, but they had this patented technology that who's behind that taxi, relevant to them would be the ad to that person. That targeted audience, so they still have that patent, but during COVID the taxis stopped. So we invested in 2019. Within 1 year, we got Base Capital. It's a Chinese VC firm, investing another 1.5 million. We participated in that round also. COVID happened. Taxis were not to be seen on the road. They pivoted their model. They pivoted to the screen in the residential and now commercial complexes as well. But they started with the residential. During COVID, they raised another round of 3 million from Qatar insurance company, QIC. And recently they got $15 million from Zomato. The multiple on their investment which investors kept getting. So I think the first March 2022 was the one March 2022, the first exit opportunity came, which was around 2.6x. And just in 6 months from that first exit opportunity, the exit opportunity became as 9x from Zomato. So this is just to show that there is no set interest in this ecosystem. It can go zero, but it can be 1000x as well. Alright, thank you. That was all from my side. If you have any question, yes.
For the students, you can explain from your experience, how do you find the companies failing? You said that 30 companies fail.
Yes.
So what contributed to their failure and what contributed to the success?
Sure.
Maybe you can share this.
I was going to ask this question.
Alright, so the question is that what actually were the reasons for failure and what were the reasons for success? So I'll go with the failure first. I think the biggest reason for failure has been that their inability to raise next round. Now, why that happened? There could be multiple reasons. There could be founder, See, the investor investing in a company, it is a part of convinced by the founder to believe in that idea. But also it could be the industry scenario, like during COVID, the hospitality industry, the travel industry suffered a lot. So just like I think demonetization, there was another industry which suffered a lot. So it could be situational, but the other reason, some of the not very good reasons are the founder fatigue, founder dispute, which we have seen, which actually led to the failure of the company. Now, what help companies succeed is the resilience. The founder passion, their ability to adapt to the market. Like we just gave you the example of I don't know how during COVID it was like a no-show for them, but they pivoted smartly, which aligned with their patent, which aligned with what they can scale. So that founder resilience, there has been model like even travel industry have known that during COVID, badly stuck, but now how they have come back after COVID, how they are succeeding. There are hotel management system startups as well. There were no hotels which were operating at COVID. There were no revenue, but they used that time to build their tech to make it more resilient, to make it more stronger, to be able to, when after COVID, now they're able to scale faster than pre-COVID.
You just talked about hotel. I have came across more than 50, entrepreneurs, and the young generations, they started the hotel industry either is on roads or on the rents, but don't know reason. But I have seen more than 50 people belong to me. Personally, I have seen they have to close down their restaurants. What could be the reason according to you?
Okay, I don't know how much I could add value to this one because this is not really an innovation. It is a restaurant business which failed. It's like any boutique which failed. It's just. For a failure of again, as I said, it could be situational. It could be competition. Somewhere, another restaurant performing better and in the same area being able to service and supply better than that. It's the product market fit failure. I'm sorry, I would not be able to add value to this one. Okay, anything else? Alright, thank you guys. If you need to contact me, I'm available on LinkedIn and I'm active. I'll reply within 1 day or 2 days max. Alright, thank you.